Now, what if a firm has non-constant growth? We've looked at several examples for constant growth model, but what happens if a firm is expected to increase dividends by 20% in 1 year and by 15% in 2 years? After that, dividends will increase at a rate of 5% per year indefinitely. If the last dividend was $1 and the required rate of return is 20%, what is the price of the stock? So that means we have to find the present value of all expected future dividends. And the years where it's non-constant, we will have to do those individually from the ones that increase at a rate of $5 per year. So let's look at an example for that. So we have $1 dividend with a 20% growth. So the next dividend will be $1.20. After $1.20, the next year's growth is 15%. So for dividend 2, we have $1.20 times the 15% growth rate, which gives us a dividend of $1.38. Once we get past year 2, then we're going to have a constant growth rate of 5%, which then gets us to D3 or dividend 3, which is $1.49. So to find the expected future price at the beginning of the constant growth rate. So what is the expected price at year 3? We take the third dividend of $1.45 divided by our required rate of return of 20% minus that growth rate of 5%. And that gives us a price of $9.66. We then add that to year 2 to find the present value of the future cash flows. So then we have the year 1 dividend plus the year 2 dividend plus the price at the beginning of the constant growth to give us the future present value of the expected future cash flows. The basic present value of all future dividends formula looks at the non-constant plus constant growth. So where we have to do each dividend year individually and until we get to the constant growth to get the dividend growth model. So extended for non-constant and constant growth put together, then we have the 2 years of non-constant growth. So the dividend 1 and dividend 2 that had different rates of return. We do the present value of those separately, and then the present value when we get to the constant growth. If G, or our constant growth, is constant after our time period 2, then P2 equals the dividend 3 divided by the return minus the constant growth. Okay. This can all be very confusing when you're just trying to read through it or state it. So let's look at a timeline. So we have our year at 0 time, it's $1. Our growth in year 1 is 20%. So at the end of year 1, we have $1.20. The present value of that is $1.20. Then we have a growth of 15%. The future value being $1.38. The present value of that calculated down. And then constant growth of 5%, giving us, if we add these 3 together, the present value of $1.20 is 1 here. The present value of $1.38 back 2 years is 90.9583 cents. And then the present value of our constant growth back 3 years is $6.70, giving us a price of $8.66. So how do we use the dividend growth model to find the required rate of return? So if we start with the dividend growth model, and rearrange to solve for the required rate of return. We then have the dividend in period 0 times 1 plus the growth rate over the price plus the growth rate equals the dividend 1 over the price plus the growth rate. So let's look at an example for that. We're trying to find the required return. A firm stock is selling for $10.50. They just paid a $1 dividend, and dividends are expected to grow at 5% per year. So what is our required rate of return? We have a price of $10.50. Our dividend was $1, and our constant growth is 5% each year. So the required rate of return, if we put it into that formula, is 1 times 1.05, which is our growth rate, divided by the price of $10.50 plus our growth rate 0.5 equals a required return of 15%. We can also look at the dividend yield. So what is our dividend yield? Our dividend yield is 10%. So 1 times 1.05 divided by 1050. So dividend divided by price equals our dividend yield, which is 10%. Our capital gains yield is 5%, which is the growth. So our rate of return is the dividend yield plus the capital gains yield, or 15%. It's just another way to calculate out what the required rate of return is. For stocks that don't pay dividends or have erratic dividend growth, we can value them using their price earnings, or PE ratio, and their price sales ratio. So the price at time t equals PT, which equals the benchmark PE ratio times the earnings per share, or the benchmark price sales ratio times the sales per share. The price sales ratio can be especially useful when our earnings are negative. So let's look at an example using the multiples for our valuation. So suppose we are trying to value the company in Activision. This is a video game developer that does not pay dividends. If the appropriate industry PE for this type of company is 20, so that's the price earnings ratio, and we predict earnings to be $2.50 per share for the coming year, then the forecasted stock price for a year from now, our target price, is $50. So the PE ratio of 20 times the earnings per share of $2.50. Now we're going to talk about the features of common stock. So not only trying to calculate what the value of common stock is, but now we're looking at why would people even buy common stock. So we have our shareholders' rights. We have voting rights in stock. We're allowed to elect the directors, and then we have cumulative voting versus straight voting. So with cumulative voting, this is a procedure in which the shareholder can cast all votes for one member of the board of directors. So the effect of cumulative voting is to participate minority participation with minority shares holders. So the number of votes that each shareholder can cast is determined by the number of shares they own multiplied by the number of directors to be elected. With straight voting, each of the directors are elected one at a time. So this is where a shareholder may cast all votes for each member of the board of directors. So then you're with straight voting, you just vote based on the number of shares you own. Boards are often staggered or classified. So when we're looking at a staggered or a classified board, staggering makes it more difficult for a minority shareholder to elect a director when there's cumulative voting. And it makes takeover events less likely to be successful because it makes it more difficult for a small group of people to vote in a majority of the board of directors. So staggered elections mean that only a fraction of the board of directors are up at any given time. So instead of electing an entirely new board, in staggered elections, we might vote for only 20% of the board at any given time, and the board seats are rotating, so they don't all come due for replacement at the exact same time. This can help to, as I said before, to prevent corporate takeovers by taking over a majority of the board. A classified board is just another word for a staggered board. Proxy voting is where you grant the authority of someone to vote for you. So, for example, if I have 20 shares in a stock and I'm allowed to vote for the board of directors, but I don't want to go to the annual meeting and they require a vote in person, I can elect someone as my proxy who is going to be there to vote for me. Okay. We also can have classes of common stock. So some firms have more than one class of common stock. The different classes generally have different voting rights. Google is one that I can think of that has Class A and Class B shares, just off the top of my head. In the textbook, they talk about Ford Motor Company. Ford Motor Company has Class B shares that are not publicly traded. Um, Only Ford family members are given Class B shares. So in some companies, the different classes of shares, one of the classes might be given to employees as bonuses, and then the other class is traded publicly. So Google, as I said, they have A, B, and C classes. If you look them up, Class A shares are sold to the public, and Class B shares are part of bonuses that employees get. Other rights that common stock can have is that you share proportionally in declared dividends. So if you have one share of stock, you get the dividends for that one share. If a company goes out of business or declares bankruptcy, or they liquidate all of the assets, common stock shareholders receive a proportion of what is left when we get to stockholders. You also have a preemptive right to stock. So if a new stock issue is being released, you have the right to buy it first to maintain your proportional ownership in stock if you desire. So if I own 10% of a company and they were issuing new stock out that was not currently outstanding, they would come to me first and say, do you want to buy additional shares so you maintain 10% ownership? I can accept that and maintain my 10% ownership, or I can decline that. Dividends are declared by the board of directors. Companies are not required to pay dividends. If they choose to pay dividends, the board of directors declares them and then they become a liability that needs to be paid out to their shareholder. A firm cannot go bankrupt for not declaring dividends, and dividends aren't required unless it's some kind of stated stock. Dividends are not tax deductible for the corporation, and they are taxed as ordinary income for individuals. If corporations own stock in another corporation, then if they receive dividends from that corporation, they do get to exclude some of that from taxable income. So, like if Google buys stock in Microsoft, because they can, because it's an investment, and they receive dividends from Microsoft because they're a corporation and they get double taxed anyway, they can exclude 70% of their dividends from their taxable income. Features of preferred stock is that the dividends must be paid before dividends can be paid to common stockholders. Preferred stock has stated dividends. They are not a liability of the firm, and they can be deferred indefinitely. If preferred stock is deferred, then any time that a company declares dividends in the future, they have to pay the preferred stock dividends before they can pay any to common shareholders. Most preferred stock dividends are cumulative, which means that their preferred dividends have to be paid. Preferred stock generally does not carry voting rights. So the benefits of preferred stock are the guaranteed dividends, and especially if they're cumulative dividends. The stock market, we talked about this a little bit in chapter 1. We have a primary or secondary market. The primary market is new issue, and the secondary market is existing shares that are traded among investors. We can also have dealers or brokers. The dealers is ready to buy or sell at any time, and a broker brings buyers and sellers together. So if I wanted to go and buy stock on the secondary market, I would do it through a dealer, and dealers bring the buyers of the stock and the sellers together. There are two different stock exchanges. So the main one that we look at is the New York Stock Exchange, or the NYSE. It was members historically had to buy some unknown reason. My PowerPoint decided to crash during the making of this video, so I just paused it until PowerPoint came back up. So sorry for that interruption. The New York Stock Exchange was created in 1792. They have merged with other stock exchanges throughout time. Historically, before 2006, members had to buy a trading license or own a seat in order to trade on the stock exchange. We had designated market makers. These were the members who acted as dealers in particular stocks. They were also known as specialists. And then the floor brokers. So the floor brokers are the ones that are bringing the sellers to the dealers in order to make sure that transactions happen. So this is all historical information. Then the supplemental liquidity providers are investment firms that are active participants in stocks assigned to them, and they want to make a one-sided market, and they trade purely for their own benefit. In 2006, the buying a trading license or owning a seat rules changed, and people still have to be members, but it's a flat rate for what a member can do. So the operational goal of the New York Stock Exchange is to attract order flow. So those designated market makers, or DMMs, are assigned to a broker or dealer. So each one has their own assigned, and all trading in that stock occurs at the designated market maker's post. So if you've seen on the floor, most videos when you see like the stock market floor are filming at the New York Stock Exchange. That trading takes place between customer orders placed with those DMMs and the crowd. And the crowd is the brokers who are working on the floor. We also have NASDAQ. So NASDAQ was a member of companies listed and the shares traded. It's bigger than the New York Stock Exchange. It was introduced in 1971 as a computer network of securities dealers. So we have multiple market makers and electronic communication networks and 3 levels of information. Level 1 is median quotes and their registered representatives. Level 2 is that you can view quotes, brokers, and dealers. And with a level 3, you can view and update quotes. So dealers are the only ones who have level 3 access to information. There's a large portion of technology stocks on NASDAQ. So unlike the New York Stock Exchange, NASDAQ does not have a physical location. Then we have ECNs, or electronic communications networks. They provide direct trading among investors. They became popular in the late 1990s. ECN orders are transmitted to NASDAQ. They're all electronic orders. This is more stock trading as we currently observe it. It's more common to do an electronic trade now than it is to call down to the floor of the New York Stock Exchange and do physical trainings. You can observe online training online if you go to this website. And then the last slide, we're going to talk about how we read stock quotes and the amount of information that we get from the stock quote. So the current stock price, as we can see, is in the upper left corner. It's $45.61. The stock price fell by 7 cents during the day, or 15%. We can also see more information. So we could see that the previous close was $45.68. That's the closing price from the previous trading day. And open is the first price of the current day. The high price for this day so far, shown in the day's range, we can see what the current day's range is here. And the week's range. The bid and ask are the highest price someone was willing to pay and the lowest price someone was willing to take. So we have the bid and the ask. So for example, 45.57 times 1200 tells you that someone was willing to pay $45.57 a share for up to 1200 shares. Beta is an important number that we're going to get into more in a future chapter. The PE ratio, the earnings per share. We have the ex-dividend date, their forward dividend, and their yield. And this is information that we could use in the calculations to estimate our future prices. So these are all of the different things that we can tell from a stock quote. We can also see how that stock progressed throughout the day. You can look at 5-year period, 1-year periods, year-to-date information, 6 months, 1 month, and 5 days